Hey guys, it's Dave. We're going to do a real estate roundup and kind of give you an update on how things are going in the real estate market and a little bit on the overall economy because that does affect our traffic. It affects interest rates and jobs and all of that kind of thing. So let's take a look first at the federal funds rate. I showed this video a couple of days ago, and as predicted, we did have a 0.25% rate hike to take us up to the 5% mark. Most people believe that that's the last one that we'll see, and then we could even start to see rate declines as early as July, and then potentially even more as we head further down into the year. That's important because interest rates are, for mortgages are kind of tied to this, not directly. I don't want you to think that when the Fed raises their federal lending rate by 0.25, that mortgages go 0.25. It's more about how investors look at long-term investment strategies. And then if the 10-year treasury note is yielding down, then mortgage rates will yield down to compete with that, and vice versa. If they're going up, then mortgage rates are going up. So what we've seen with the raise in the interest rates is we saw the 10-year treasury this week go down. So we peaked at like a 3.6, and then it's been down the yield most of the week. And we haven't seen 3.36 in a little bit. If I scroll back, here's a month. So, I mean, we're doing pretty good here. Definitely on the downtrend. What that looks like for mortgage rates, this dark blue line is the 30-year fixed average. It's at 6.5. I got quoted, not for me personally, but for a buyer, a 6.5 interest rate this week, but that was for a cash out refinance. So I think if you're decent credit score, 20% down, you're probably closer to 6%. That seems to be kind of where we've been bouncing around. The FHA loans and the jumbo loans have kind of been around the 6% rate, and that seems to be kind of how we're doing. Let's look at something I haven't shown you on this channel yet is traffic. So there is a software program called Showing Time that is widely used across the nation. It's kind of like a calendar for showings. It's pretty good because not only can a buyer's agent go in and request an appointment, but the listing agent or the homeowner can approve or disapprove or suggest alternative times. And it also lets you see the calendar of showings so that we don't have overlaps in showings. But they've been collecting data on those showing requests, and so we can kind of see how traffic has been based on how many appointments get scheduled. And so this chart, I don't want you to get misled by it. It basically treats January 1st each year as the starting point of what traffic is, and then it follows along whether or not traffic goes up or down. So this lighter blue line, that's the COVID plunge of 2022, and then the orange line, that's where we're at now. And you can kind of see we're just basically in the middle of 2021 and 2022. Not of overall traffic, just in how the spring season is going. We started January, we have a spring rush, and then you can see it tapers off towards the end of the year. September is here, and then you kind of head below the January level sometime in November for most years. So it looks very average at that point. Another way to look at it is this chart here. We have a big drop in traffic from a peak, let's say that's maybe March of 2022, down to almost like 2016 levels, and then we've come roaring back for traffic. So this is a little more accurate in terms of the overall traffic we're seeing. This looks like the third best spring for traffic we've had since this chart goes back to like 2014. So yes, we had a crash in traffic, but we've also had a spike in traffic to make up for it. We have, if you want to look at kind of historically before COVID kind of messed supply up, you see this normal pattern of peaking in spring, going down in the winter, and then kind of each spring is a little bit higher, each winter is a little bit not as low, just making a higher low, if you will. And then things go crazy during COVID. To look at it from a percentage standpoint, April of this year was down 10% over last year. and then we had it really bad down to 32% from December 22 versus December of 21, and now we've kind of rebounded and we're only down 21% from the previous year. So traffic is starting to recover. Let's go to Redfin. This is the number of new listings. They're continuing to see the spring rise, although we are well off pace of 21 and 22. Here's the COVID dip. We're above 2020 now. The number of homes sold, we are still down over the previous 3 years, trending up, but that's where your crash is. The number of homes sold is a lot less than it was the previous 3 years. And then the median sales price is trending up. I mean, we're only down 3% year over year. And I did the math earlier on this. We're only down from a high of 387 down to 366. That's like a 5.5% crash. Now, look, this is the median sales price of all metros. And we can go hyper local if you want and look at Austin and look at Boise. They're kind of telling the same story. Those are the ones that are struggling. Miami is looking really good still. Houston's looking good. Let's look at Portland. I haven't looked at that in about a week. And let's see how Portland's doing for median sales price, ticking back up. Let's look at number of listings. It's climbing, and the number of homes sold is still below all three. It's kind of the same story. I think housing is starting to, I don't say it's not coming roaring back, but it's really being stubborn if you're looking for a crash. It just doesn't want to crash. So that's kind of where that looks at. As far as forecasting things coming forward, we're predicting a recession. Most people have been talking about that. It's like the slowest onset of a recession and maybe the most forecasted recession ever. But I came across some new data that I thought was pretty interesting. This is the correlation between short-term treasuries and long-term treasuries. This is a 3-month and the 10-year. And every time that ratio gets below 0, which it was here, you get a recession. That's the gray line. Goes below 0 again, and this is the dot-com bust. Here goes below 0. This is the financial crisis. We had almost like a little foreshadowing of the pandemic, which is strange. So this is either a false read, because the only reason we had a recession here is because we closed the economy down. But then obviously here we got Wile E. Coyote running off the cliff and holding the little flag up that says yikes, and going off a cliff. So anyways, that does not look good. If you just study one chart, is a recession coming? It looks like it might be coming. This is a chart of the federal funds rate. And what I wanted to show you on this is that in correlation with where interest rates are for mortgages, we could be due for a dip or a lowering of those rates, like I showed in the first slide, where it's predicted that the rates come down. That's what happens. We raise rates and then cause a recession and then cut rates to help recover. And the whole reason for that is to stop inflation. We need to stop the price increases so they make it tougher to borrow. They make the economy slower. People start laying off. We stop buying, and the GDP drops. We have a recession, and then the Fed goes, okay, that's enough. And then they start cutting rates. So we did it here for COVID. We did it here in the financial crisis. We did it again in 2021, the dot-com bust, and so on. It gets a little weird here. This is where Paul Volcker was experimenting, and we went from rates in the 20s down to the 10s, all over the place. And we had about a 4-year period where the economy was almost in a recession if it wasn't, if it was close. So I think by the end of the year, we'll see rate cuts, and that will be really good for housing affordability. I keep seeing people talking about how homes are the most unaffordable they've ever been. And that's a true statement. And so they use that to say that that means home prices have to crash. They have to come down. And they don't. Rates can come down and bring affordability back. And so if housing prices can hold out towards the end of the year, if we don't get a huge gain in unemployment where people are forced to sell their homes, we could see interest rates drop to the point where the affordability comes back and you don't need to see a crash in house prices. That's what I'm hoping for. That's the best case scenario we could hope for. And so I think that's what we're headed for. I'll continue to report on that. If you want to see more stuff like this, stay tuned by liking, subscribing, and if you want to see any additional comment, I'd love to hear from you in the comment section below. Thank you so much for watching, and I hope to see you again soon. Thanks. Bye.